Okay, welcome everyone to the next in the Startup Diaries podcast, hosted by Bern Sheehan. Today we have a Jackson from GC Angels joining us. So not actually a founder or a CEO of a startup, but someone who's heavily involved with them from the investment VC side of things. So obviously Jess is joining us today to hopefully give you all a bit of an insight on what it means to actually go to start speaking to someone like yourself to add funds to your business and start raising money. So Jess, welcome. Thanks for joining us today. Really appreciate it.
Yeah, thanks for having me.
Good, great. Shall we just dive straight in? Do you want to just give us a bit about yourself, your journey, and I guess how did you get to where you are today?
Yeah, of course. So at the moment, and hopefully for the foreseeable future, I am investment director at GC Angels. And we are one of the leading early stage investor in Greater Manchester, the Northwest, and certainly one of the top, on the top four in the whole of the North. What that means is we invest in businesses where it's often their first funding raise or before they get ready for venture capital funding. That can be anywhere from sort of rounds of 100K up to a couple of million, where they've not quite reached the volume that they need to qualify for VC funding. Since we got our own fund back in 2018 now, we've invested in 22 businesses over 25 separate deals. So we've been very busy. And our active pipeline at the moment is absolutely crazy. So, COVID-19 has done nothing to stem entrepreneurialism and people wanting to grow businesses, which is really good news. As to my journey, I actually have quite an interesting background in that I worked in a group of startups for a while in a sort of operational role, while at the same time doing angel investment deals on behalf of a high net worth's family office. So getting a lot of exposure to a lot of different things at the same time. I've also worked on small M&A, so mergers and acquisitions, for anyone who doesn't know, and integration of the businesses subsequently to the acquisition. So it's a really, really interesting area. And, a lot of this stuff sounds transactional and financial, but actually it's all about people, really, which is, I really enjoy that aspect of it. So yeah, and I'm here now and really sort of enjoying challenging some of the status quos in the investment world, which I'm sure we're going to get to talk about today.
Yeah, we will indeed. What do you think the sort of current state of the ecosystem for startups, scale-ups in the North is at the moment?
I think there's just a huge amount of things available, and I think whilst that can be positive, it can be quite hard to see the wood for the trees, or actually what is going to be useful to me. I mean, I personally wouldn't want to be a startup right now having to think about COVID-19, having to think about EU transition and all of those kinds of things, let alone funding and growing and worrying about staff. But I mean, in general, the North has over the last decade or so really had a huge influx of VCs. So we see them popping up more so in Manchester and Leeds and Birmingham, although Birmingham's the Midlands, but we'll ignore that for now. And Edinburgh obviously has a really good financial ecosystem as well. But I mean, it's nothing compared to London. So when you kind of look at we'll talk about the angel landscape as well, because it's, whilst looking at how many VCs pop up in the North, it is a positive indicator. It doesn't actually help a lot of startups, as we kind of talked about in my intro. If you're one in 100 grand, you're not going to get it from Mercia or a Maven or an NVM or a Palatine. You're more likely going to get that from an angel investor. So I think the statistics are quite stark in that I think it's over 70% of all angels are in London. And a huge chunk of those have only made investments into London. So when you actually think about being a startup in the North and wanting to be stubborn and raise your money from here, you're already, against it somewhat in trying to get access to that capital. But that said, businesses like ours have actually built a tech platform that will allow angels, regardless of where they are, because actually we don't care where the angels are, can come and join us and get access to deal flow. I think that's always been really the challenge in knowing what's actually out there, and how to get access to it. And actually, COVID-19 has really accelerated that digital adoption. So we were doing pitch events pretty much straight away online into lockdown. People could go and view our deals on the platform pretty much straight away. So, you know, we've been able to adapt where I think maybe the more traditional angel networks of, you know, come and have a sandwich and rub elbows has been very challenging.
Yeah, that's fair. From my side of things, I mean, a lot of the conversations I have with these sort of budding tech startup entrepreneurs, there's not I don't want to say there's an ego to it, but maybe it's just a bit of lack of knowledge. They often come to us and think that they're just going to be guaranteed investment. They just think they've got great products. You know, they might have been they had this idea, they love it, they bought into it, hence they went to run a business behind it. So I think a lot of them hit all early on, so with it, because they don't understand how to approach it. So in the instance of me being a startup, I'm a startup considering fundraising options. You know, where do I start? How, you know, could you take us through some of the initial steps, what to consider and how to approach that angel investment round of investment?
Yeah, absolutely. So, I mean, it's interesting that you talk about ego, because, you know, some of those lasting anecdotes that you have about how crazy was your day today have been around, you know, some of my meetings with startup founders. So, yeah, I mean, it usually starts with, you know, you've got an idea. It doesn't even matter. You don't even have to have started your business these days to approach people for funding. It doesn't mean you're going to be successful, but, you know, you don't even have to have traded. So it usually begins with a pitch deck. So I'm fairly sure that everyone listening will know what that is. It's you know, a digital or a paper document which will kind of summarize your opportunity, lay out your product market fit. How much money you want, crucially, is often missing from that. Like, come on, guys, help me out here. And what you're actually going to do with it, and you know, where you're going to go, where's that going to take you at a high level. It usually starts with that. So whether that's sent directly in an email, or I don't know, someone puts it into your hand. That's never happened, actually. But yeah, it kind of starts there and saying, can we have a conversation? And in my kind of remit with my investment director hat on, I will screen that as well as all of the others that I get, to see if it's going to fit our fund criteria. So anyone you approach, VC, an angel, will have an investment criteria, and that's often the hardest thing to try and navigate, because often a lot of funds don't even want to go into detail about what that is, because they always want to keep themselves open for something sexy. But it's very hard if you're like, well, I only want to come to you if it's not going to waste my time and yours. You know, some founders are probably overly conscientious of that. So yeah, it can be really hard to sort of find, where can you even find the right individuals to approach, for example, if you're in a particular sector, or you are, you know, a social impact business, for example. There are impact funds that you can approach. So working out who to go to can often be the hardest thing. But, you know, there's lots of great tools out there. So, you know, if there are any startups listening to this and they're thinking about embarking on going out for funding, and it's your first raise, then you're probably going to want to talk to angel groups or early stage funds like SCIS funds or EIS funds, for example, which are tax structures that entrepreneurs use to, investors use to get tax relief. You can actually browse by sector or by region, if necessary, what funds are available or what angel groups are available. So you can do that through the UK BAA website and by browsing their members. So that's the UK Business Angel Association. So it's a really, really great platform to go and search. But I guess, like, it's always fun, isn't it, to go to actually start to talk about some anecdotes of stuff that's happened. So I you always remember the meetings where you think, God, if I could just tell founders to never do that, we'd be in a much better place. But you know, I've had people come to meetings and sit down with me, and I've got the deck in front of me, and they you know, they've said that they want 5 million, and essentially what they have is the paper in front of them and nothing else. And that is, you know, that is what you start with. Of course, you know, your idea is worth nothing but the paper that you print it on initially, and you're trying to get someone to buy into that. And the whole journey of a startup is essentially trying to argue value for what you've built on top of that as a foundation. So whether it's IP protection, that you, some IP that you've got, IP that you've protected, you know, the actual physical product itself, then you start to look at things like turnover and cash, and you can argue value in that. You can argue value in your customers, your databases, and so on. But yeah, don't go in there asking for the world when you have very little there to begin with. What was very clear to me is that they needed to break it down. Yes, they might need 5 million over the next 3-year life cycle of the company, but no one's going to give you that now, because it would mean your business would need to be valued at a ridiculous amount of money, you know, for you to retain majority share and for an investor to come on board. So I don't think it certainly isn't an easy subject, but I think people need to familiarize themselves with the really basic mechanics of like what raising investment means. You know, it's at its core, it's giving away a portion of your business to somebody, and they're going to give you money and you swap seeing. Like that's essentially what it is. But some people just don't understand that. And you know, it is quite heartbreaking when people go up at the front of a room and pitch to investors, and they've clearly never done it before. And this is, you know, an area that I'm really, really passionate about, which is that pitch practice, and how critical that is to making sure that you're communicating effectively. You might be saying something that you think is really, really obvious because you've said it a million times to yourself, but you've never really said it out loud. And, you know, people can hear something totally different, basically. So I know I'm kind of rambling now, but I think where I would start with funding is just to be really, really clear on who you are and why you are. And if you get that right from the off, you can have some really good conversations. But the amount of sort of practice pitches I've sat through where I felt physically exhausted at the end of it, because you've lost me on slide 2. So when you take me through 20 other slides that I don't understand, you've lost me. So, you know, you really just need to understand who you are.
That's a fair point. I mean, I imagine it's quite obviously an emotional point, someone's journey as well, still very early on, but this may put a significant amount of time and effort to even get to this point. So I guess they need to be best prepped and ready for a bit of a jump into the unknown, and kind of putting themselves out there at this point. This is the idea I've had. This is what I've done so far, and they need someone like yourself or an angel to buy into that. So it must be quite actually, you probably overlook that aside the emotional impact it would have on someone if at this particular point in what would be seen as their dream. They've probably thought about it for a while.
Yeah, and you know, that the pitch practice thing, like the sorts of people that we would see in that ecosystem would be the people who are kind of going through the practice, and then there'd be the people coming to watch the other people practice, because it is, as you said, putting yourself out there it's a really personal thing. And, you know, giving people the forum by which they can practice, but also the forum by which they can see what the process is to practice, is really useful. So we would hold a practice pitch event and someone would come along and, you know, they'd talk to me and say, oh yeah, I'm just kind of getting a sense for what it's really like. And then the next time I would see them, they would be there to pitch or practice, which is a really, really nice feeling. But, you know, you do kind of, exposure is kind of a key word in that, really. You need to get used to the world, get used to seeing the faces, because it is a small world, really. As active as you know, Manchester is, it's still a small city.
Yeah, it really is.
So, yeah. So you'll start to get to see the same faces, but you don't want that to be in the scenario where you've absolutely tanked a pitch and people just remember you as that person who confused me once. You know, you want to be like, oh, I remember I've met you before, I've had coffees with you, and you went up and pitched your business, and you know, let's have a chat about it. You know, it's building relationships as well is really important.
Do you see any typical mistakes that reoccur, not necessarily at the pitch stage, but just at the initial kind of, I've got this idea, I'm bound to have money thrown at me. Other than that, but is there other typical mistakes that you see that you think potential budding entrepreneurs early stages are thinking of or are repeating? Continue?
Yeah, I think there's a few things that get lodged in when they come up with the idea, that and then it echoes in at the pitch stage as well. So I think the idea that you are the only person that's had this idea, like if I could get rid of that in everyone's mind with a magic spell, I would, because you know that natural, you have that aha moment of I want to do this, and you go through this kind of validation exercise where you're almost confirmation bias. You just go and find information that backs up your point, and great, okay, that's fine. But you should equally listen to the other voices or the other sources that are saying it's not a good idea. And that's not to dissuade yourself, but because you need to familiarize yourself with where your criticism is going to come from, right? And how you can address those conversations. And you won't win every argument, but you will win some people over, and you have to be aware of what those arguments or counterpoints will be for why your product or your whatever it is that you're offering needs to exist. So I think if I could banish that, that like it would save so many conversations, because you just hear this like this industry needs to change and we're the only person doing this. It's like, I've had 4 pitch decks for this idea this month, and that's not to say that yours isn't the best, but tell me why it is. So you're already missing an opportunity there if you're just going, we're the only ones doing this. You're missing the opportunity to say, you know, we're not the only ones doing this, but this is why we're the best, because no one else has thought of this, or we're going to partner up with these organizations and offer wraparound services, or whatever it is. You know, you're missing an opportunity to put across a really good argument. What was the other one? I think so. Yeah. So, and I think that manifests itself in the deck as well as like, we don't have any competitors. Yes, you do.
Yeah.
Just get rid of that instantly, because again, you're missing an opportunity to mitigate a point, prove why you are the ones that should exist or should get funding over any other business. And yeah, I guess
in that instance, I think you obviously, even Uber, which is so dominant, had a competitor, and things like Halo. I mean, they've completely like banished them with their dominance. But even the most successful businesses, it wasn't just like we were the only ones doing this. It was better at doing it and taking advantage of that market.
That is true. And actually, what's really interesting, I was listening to a podcast recently about, is competition killing us? So everyone thinks competition's healthy. And it was like, I think the argument that they were making was around like dominance of players like Amazon and actually like Uber. And actually in Uber wanting to argue that all of their drivers were self-employed, that they're representing a conglomerate of small business owners. And it's like, no, you're not. But yeah, like I think competitors in hyper competitive spaces, it is like, yeah, it's really, really difficult to cut through, because like I've had things come to me that have said they're, you know, the face of it. I'm like, so you're trying to tell me you're competing with Deliveroo then, because actually you've got this tech that does X and does Y. It feels to me like that would be the more sensible place to pitch yourself, because it would differentiate. And they just go, no, we're competing with Deliveroo. And I'm like, okay. And we never speak again. Just this kind of understanding of sometimes it's not going to cut through it's not enough just to say that you're competing and we're going to just basically, it's a scrap for the bottom for market share. Maybe there is money in that, maybe there isn't, but I just, you know, some investors might get that, but I think we ultimately like to look for things that really light your fire, that they're really innovative, and a fight for the bottom on sales margins doesn't really do that for me. But you know, we like to look for things that are really attempting to change a market, or you know, innovate in some way, in, you know, digital transformation in an entire sector. You know, we've got quite a few Edtech businesses in our portfolio, where there are, you know, the argument for them existing and prospering was there, and then COVID-19 came along and everyone was going, oh my God, we've not got any digital tools. It's like,
yeah.
here are several. So yeah, it's yeah.
Good. Well, one of the big things that's come up repeatedly, and I think we've discussed it as well, and with the other podcasts we've had, but especially at the angel stage, finding the right personality in the investor or the VC with regards to the company culture and their fit with the investors. What's your take on this? Is it something that you look for on the other side of things when you're investing for the right personality and cultural fit in the businesses that you're working or want to work with going forward?
Yeah, and I know that we'd sort of had a discussion on this previously. So, you know, angels and VCs, private equity houses, anyone on that kind of scale of getting your first funding rounds to getting your Series A, B, Cs, and management buyouts and all of that kind of stuff, will all agree on there needing to be you know, a good management team, and there has to be this cultural fit, and okay, at the face of it, I can't really disagree with that, but I think it is a dangerous area, and I know we talked about this before. So what I mean by that is, when you look at the makeup of everyone who works in VCs, who works in private equity, they are predominantly white and they're predominantly male. And, you know, it is human nature that we look for things that remind us of ourselves, which is why VCs back, you know, 80% of their money goes to all male founding teams, you know, 10% to mixed gender founding teams, and 1% to solo female founding businesses. There's reasons that those things persist, and it's because people invest in what they are. And you know, you read stories like some which are quite amusing, but it actually underneath it all, it's quite disturbing. So there was one story about I think it was a sex toy conference or something really weird, and the product that won was a sex toy for women. And there was a prize associated with the winning product. Oh no, it wasn't even to do with sex toys. It was just tech. And it turned out that a female sex toy won, and they were like, "Oh, this is a bit. This is a little bit. What's the word I'm looking for? Obscene. We can't be seen to sort of awarding the cash to this." And the lady whose product it was, whose business it was, hastened to add that. Well, it's funny that you're saying that to us, because a couple of years ago, a male sex toy won, and you didn't have any issue. You didn't have any issues with that. So it's really interesting. But and also when you look at sort of how drug studies have been run, you know, you start to get into the Caroline Criado-Credez world of she's done a book called oh my God, what's the book called? I'll come back to that. It's basically the women in data, that we're absent in data, but we're also absent in products that we're invested in. And female sexual health is so poorly understood. All of our products are very poorly funded, but we're 50% of the population. So like, to say that there isn't a market for something that's aimed at women is of course absolutely ludicrous. So what, you know, that basically results in, you know, and say, yes, we want to look for cultural fit, but what that ends up looking like is, you know, white men getting their businesses funded, and anyone who doesn't to the same level. So it is an issue that I'm very passionate about and I speak about very regularly, which is that we need to look at improving what we do in this sector. We have to take a real responsibility for what we do, and I've been forming some working groups with other investors across the north on different areas of this, but looking at like, you know, where you get advice for, you know, for investment panels. So if you've had an idea for something that's marketed, so let's just say, for example, it was like products aimed at Black women for their hair. I don't have, I'm not Black, I don't have hair like that, so I don't know if a product is going to be good or bad. So actually it would be great if I had access to people who I could say, is this a product, is this a market, what does this look like, is this a good idea or isn't it? And likewise, if I was male and it was a female sexual health product, or even just aimed at women, that I had women I could speak to say, is this valid, is this a good product, does this market exist, are their assumptions correct? Or even go one better and make sure you've got a diverse investment team, or, you know, an investment panel and the senior leadership at VCs and so on. But I mean, let's put that to one side for now. I think, you know, finding the right fit with management team is important. And I think what it really is talking to at the heart of it is, do you actually think the management team has the right skills, has got the right attitude to grow and scale the business? And that doesn't always mean that someone you have at the start of a business's journey is going to be the right person to take it through to Series A, Series B, and Series C. You often, you know, get founders exiting around that point because they've done the really good stuff and grown it, and got it through all of the nitty gritty side of it. But when it's like, right, we just need to kind of cash cow this business essentially and start it to churn the money out or go into new markets, then it might be a different person. But generally at the early stage, I think, I was actually talking to an investor yesterday who is looking at becoming an angel investor for the first time. He's only ever sold businesses, grown and sold them. And he was saying, well, what would my typical involvement be with a company if I invested, and what are the kind of factors that influences that? And I said, well, there is no one single answer to that. You know, you have a set of skills, the founders have a set of skills that they have, and then the set that they don't, that they're going to need. So firstly, can you know, give them any of those skills, insights, contacts, connections that they need to grow it, that they don't have at the moment, that will, you know, add value over and above the cash that you're going to put in as an angel? Could you actually join their board formally as a non-exec, a chair, or whatever that looks like? You know, you might just want to become an advisor for them and help them, and then that's it. So, you know, it does come down to skills complement as well as like fundamental belief in what they're doing. But yeah.
That's great. And I really want to go back to the earlier point, really, around obviously something you're passionate about. You can tell when you speak about it. Obviously, it is notoriously harder for women to funding, and then on top of that, it's even more difficult for women of colour to then receive investment as well.
Yeah.
What more do you think needs to be done to address this imbalance of funding and make it a level playing field?
Yeah, I mean, we've obviously talked about some of the obvious things, which is just employ people that aren't male and white to actually look at deals, and you will naturally just see that diversity come through. A lot of what funds will tell you is, well, we just don't get applications from Black founders. We don't get applications from women to the same level. So, I mean, we can only do the deals that reflects what we have coming in, right? And I think, okay, but also you need to think about what is your reach at the moment. So I think, you know, there'll be some founders listening to this, and founders that I talk to regularly. There are certain funds that you will never bump into at a networking event ever. And it's because and you know, quite rightly, well, not quite rightly, but they never need to go out and network because there's already the intrinsic demand for what they offer. But unfortunately, what that therefore means is they don't really get exposure to new types of people. They do business in the old way. So when you actually map through, again, I'll dig out the statistics, but it was in the British Business Bank report for female women getting investment from VC that was published in early 2019. It was like the amount of deals that get completed that were brought in by a warm introduction. So that is someone else going, it's all right, Chris, I'll sort you out with an intro to this fund. It's all through that kind of known associate model. So obviously that's the old school way of doing business. And then it tends to be the case that all the old school people in that space are white men again. So it just, the habits are just stuck and embedded. So if they were actually forced to generate their own pipeline in different ways, going out to events, such as ones that we might host, or female tech founder that Chi runs in Manchester, there's so many others that you could just go to and be like, hello, my name is, and I work for this fund. We invest in these areas, and leave a couple of business cards. Instantly, you're going to get people approaching you or wanting to have conversations with you. And I think, a lot of women that I've worked with, not all, but certainly some, they're a bit more risk aware. So it's like, well, what's involved in funding? And I need to know everything before I can embark on this journey. And I just think that it's such a laudable characteristic to be like, I need to just know the crap out of everything and be so prepared. But unfortunately, what that results in is us not going for stuff, whether it's a job or getting that application in for investment. We hold ourselves back with our need for perfection, and we already know through science that is just not something that gets in the way for men. I think it's...
I completely understand that. I mean, it's exactly the same in the recruitment side of things. I don't know the stat in my head, but I think... Is
it 3 out of 10 skills a man will apply, and women have to have 8?
Yes, yeah, that's the one. Yeah, they'll just, a man will just go, yeah, go for it. Sometimes it can work out, and it's just that, where, like you say, a woman might actually hold themselves back a bit, rather than just throw themselves in and be a little bit, I don't want to say ignorant for men, because they just kind of go, yeah, well, I'll look all right for it, I'll throw my CV in. But women, like you say, take the time, have a look at it, think about it. It's not for all, obviously, but like, it can just something that causes this to an extent. And I didn't realize.
Yeah, we have to take responsibility for that, and and actually flipping it from the investor side, when you think, well, why don't men invest in women? Because like, I've sat in rooms where there have been investors who have said, I've invested in this particular investor wasn't a white man, but he said, I invest in women and I invest in businesses that have been founded by immigrants, because they just have this fire. They just have this thing baked into them that they want to prove themselves, and they have this motivation and an incentive, and they just go out and do it. And we already know that the stats for more diverse teams in gender on the FTSE outperform others. And then when you have a diverse team in every other sense, it outperforms even that. So the arguments are there, because diversity of, when people say diversity of thought, what we really mean is that's not a cop out for having a lot of white men or white faces around a table. We actually mean people from different class backgrounds, different economic backgrounds, different races, religions, genders. We all have different perspectives, and that makes more well-rounded businesses. So it's just so obvious. Certainly it feels that way, and there are, there's data, but unfortunately it's a difficult one to overcome. So I think for another thing that I know we have to solve, stop saying we think, we know, understanding the scale of the issue is important. So when it comes to women, we've got this data available to us, the really great work that the Alison Rose Review has done, and you know, the British Business Bank and UK Business Angel Association, and I know Bowhurst consistently report as well. But there is a startling lack of data at the same level that we can benchmark against as a fund for Black and minority ethnic founders. So we're not actually able to say, you know, looking at our portfolio today, you know, circa 30% of our money has gone to a business with a Black or minority ethnic founder. I mean, I think we instinctively know it's probably better because of the statistics for women, but we don't actually know that. We don't have anything to benchmark ourselves against or to say this is the level at which we do better, and we always want to do better. But yeah, we have to know the data before we can, you know, understand how much further we have to go as an industry, not just as individual firms.
That's great. That's great. I do love the passion of it, because obviously it's something I wasn't really aware of. But then if you look back just on our podcast series,
we did speak about that.
Yeah, well, it's one of those, and I have been obviously trying to be a bit more targeted in lining up the next speakers, and obviously want to tap into your network on that front as well. But it's important for me as well to make sure that we do have that diversity on here, and diversity of thought and different experiences that people are going through. Like, you know, I'm not saying that the people that I've spoken to already have had it easy in any sense, but they'll have had it in a different manner, a different approach, different way, different journey to you know, a female founder. And I can thankfully say there's more and more popping up in the North in particular. You see sort of in the headlines of the news, raising funds. I'm seeing more of it, which is great. But I imagine there's still a long way to go with it, but
yeah, absolutely. And I think, you know, visibility is critical. And I think I was talking to a journalist once, and they were like, well, who are the kind of success stories in the North? Like, who are they in a kind of way, you know? And I was like, well, that is a problem, and they are out there, but they're probably just getting on with their lives. Like, they don't necessarily want to be held up as, look what this woman can do. Like, I mean, that's kind of patronizing in its own way, but I understand where maybe he was coming from. But I was like, well, a lot of the women I admire they're just starting their journey. You know, they've raised 250 grand or a little bit more, but they're still like just absolutely smashing it. Why are they not, you know, kind of held up just because their business hasn't made millions yet? Why can't we hold them up as examples of what, you know, women can do running businesses? And it's kind of an interesting one to try and get a balance of. Yeah.
Right. Look, moving slightly away from that side of things, a few of the stuff that when I've been speaking with entrepreneurs that they would love, I imagine they'd love to ask you directly and get sort of an honest take on it, is other things around sort of that investment front. So one of the phrases that's come up a lot is the phrase cash runway.
Mm-hmm.
Could you sort of talk about that? What does it, you know, what does it actually mean, and what advice do you have for defining and adopting an action plan around a solid cash runway?
Yeah, so really basically, if you think about it, like, I always think about it like you're at an airport, you know, it is literally a runway, and you don't want your plane to land on the tarmac. So the plane coming down is the cash leaving your bank account. And what you really want to do is just get the impetus that you take back off again, such that you don't dip below zero. So essentially, you'll hear runway sometimes post investment, but often pre. So if you're raising 250 grand and someone might say that doesn't sound like a lot, and you know, often that can be frustrating in and of itself, because it's very hard to get any cash, let alone, oh, I think you need to raise more. But they'll be looking at what you've outlined that you need to spend the money on, and literally where in the calendar is that cash going to take you. So you'll also hear things like, what is your monthly burn rate? So over and above, so if you get any income, net that off basically what you've got going out of your bank. And if you then divide that out over what cash you've got, how many months cash runway does that give you? So when are you going to run out of cash, basically? And what you're really looking for, if you're not yet a cash generating business, because your runway, your burn rate is literally just everything in your overheads if you've not even got income yet, and you're developing your product, you're literally looking at, like where's this going to take? How long is it going to be before I run out of money, before I need to raise funding again? And we already allow sort of 6 months, generally for a business, 3 to 6 months to raise. In the current, landscape with COVID-19, private investors are a little bit more reticent. A lot of them have been putting their hands in their pockets, but for the businesses already in the portfolio, because they're not wanting those to fall over for obvious reasons. So a lot of investors have not been looking for new deals. So I've been advising all of my businesses to expect any fundraise to take a little bit longer. So basically, the amount of money that you need to ask for has to allow you the time to do that while you're running your business. And that, it's very time intensive process. But you kind of have to find a way. If you're not yet generating income, you've got to get more cash in through raising investment.
Is there any other things that are more common pitfalls that you find companies fall into when they're looking for investment? Yeah,
there's one particular area which can go one of two ways with businesses. So when it comes to, they deliver their pitch and they say, yeah, we're going to be raising 300 grand or whatever. And you, as an investor, you might say, okay, I quite like what you've just presented to me. 300 grand, fair enough. I'm kind of happy with it. What are you currently valuing yourselves at the moment? And you'll get I don't really kind of understand all of the number stuff, which initially makes me worried, because whilst that might be true and it's confusing, going back to what I was saying before about just familiarizing yourselves with the very basics of the mechanics of raising money and what it means is just so important. Because I'm just thinking, if he doesn't understand it, where is he or she getting advice from? So in this particular example, it was a man, which is why I'm reverting to male pronouns. And instantly it was sort of raising red flags there. So, my advice to them was, know your stuff. If you're going to present to investors, at least have it in your mind. So there's the two ways it can go is they can have diluted too much, or you could dilute too much, or you can be just overvaluing yourself. Both of those things could be rectified. It just depends on when it gets caught. So on diluting too much, in this particular example I was alluding to, it was actually a practice pitch event, but it was with lots of VCs in Manchester, who then asked this gentleman the question of, what are you valued at? He said he didn't have a clue. I think I asked him a couple of questions, and he actually said, can I have a coffee with you? Because I just wanted to ask you some questions and get some feedback. And I was like, yeah, of course, that's fine. Most funds, or most people anyway, in kind of investment manager position would be happy to do that. So when I sat with him and I said, well, okay, how much you've taken on investment before, have you? And he said, yes, we have. And I said, okay, well, how much how much money did you take on? And he said, whatever it was maybe it was 100 grand or something. And I asked a couple more questions that were, not hugely definitive answers, but it basically allowed me to work out that he had given over 50% of his business to this investor and didn't even realize that was a bad thing. So when I was like, okay, so do you realize what that means? And he was kind of like, no. And I was like, well, any investor that's going to come in who isn't nefarious, evidently, wants to make sure that a founder is going to retain the majority of their business, because ultimately an investor doesn't want to have to be left holding the baby if anything goes wrong. But also you're putting your money into that business because of your belief in that individual or that team. So you need to make sure that obviously you're getting a fair chunk for the money that you're giving them, but that they also have enough left such that when they dilute in subsequent rounds, they're still incentivized to continue to grow the company and raise again. It's just basic principles. And I haven't caught up with the founder since, but I think the only solution that he really had available was to either just grow the business organically with the current shareholding structure that he had, or to wind it up and start again, which is not ideal. But like, unless this particular person was willing to dilute significantly to allow him to take on further investment, then it wasn't really going to go anywhere. The other route, which was like overvalue. So a lot of people will put very lofty valuations in their decks, and they can be negotiated. So if they're like, we need this investor, or there's not really a lot of competition for investment, then they'll be like, okay, let's negotiate, we can wiggle it about. But ultimately, if someone's raised investment, let's just say they raised at 3 million in their last round, but they've not performed particularly well, or maybe there's been a real shift in their market, or they're in a situation where people have got too much equity, they might need to do what's called a down round. So that's basically raising investment at a valuation lower than the previous one. You know, from a kind of marketing perspective, it's not really a sexy message. And founders really don't want to do that. But that is why investors will contest valuations that are too chunky that they see, because it's like, if you don't have any need to do it, like you're not trying to prove something or trying to demonstrate like an upwards line on a graph, then you don't want to be in a situation when you get to the next raise and someone's like, there's no way you're worth that and you can't raise again. So it's purely about preserving some kind of sane middle ground whereby, everyone gets a fair portion for what they're doing, that the founders are left incentivized and they're not going to be, up the creek without a paddle at the next raise. So yeah, that's a common theme, I think, in most deals I work on.
That's great. And obviously this is a great opportunity, I guess, for you to plug some of your own portfolio here, but do you want to talk about some of the more exciting businesses for us to look out for in the North at the moment?
Yes, there's absolutely too many to talk about, but I will mention them. So I know that you've interviewed Michael Brennan from Toot Toot before, so I will allow that episode alone to stand up and talk about what they're doing. But yeah, fantastic business, doing great things for
awesome, Michael.
Yeah, for children's mental health and also for workplaces. We also have some businesses that I'm really excited about. So we've got one e-commerce, one fintech, and one edtech that I'll talk about, but I just feel really mean missing everyone out. So I'll just mention some business names at the end and people who are listening can go and check them out. But so the fintech is a business called Collective. So that's COLLCTIV. And that is very simply, and you know what, sometimes the simple stuff is the most elegant, because you're like, why has no one thought of this? But it's basically a payments collection app where you can, it's basically targeted at the really kind of organized person in your friendship group. So I'm not sure if that's you, Chris.
Absolutely not.
So you've got that one mate who's always like, let's do 5-a-side. Let's book a holiday. Let's all go to the theatre. We'll go and all see this thing. We'll all go to this gig. We'll all go to do this, that, or the other. And they're always the poor sod who's got to get everybody's money in. Can't keep track of it all. This is basically an app that does that. And the only person who needs to download it is that person. You can send out a link to their friends, and it's literally like 2 taps through the mobile. Amy and Pete are the founders, and it boggles me how much they do in the gaps between me speaking to them, which sometimes could literally be like a week or two, because at one point we were having virtual wine nights. So we'd be like, oh, you know, what's everyone been up to this week? She's like, yeah, I've just built a new feature, sold it to 2 companies. And you're just like, what?
Nice.
But yeah, she's doing really great stuff, rolling out some B2B offerings as well. So for the crowd pay. So if you want to kind of reach a certain volume of a sale before you like either manufacture it or ship it out for, you know, economy purposes, or you've just got a large volume of stock that you want to shift, and they've got something called crowd pay that they've launched recently. But I just love what they're doing, and I think the team is ace, and they're just going to take over the fintech world. So watch out for Collective.
Ironically, I think I could use that. The one thing I bother to do every year is get all my high school friends together to play a football match, 5 or 7 aside at Christmas time. We call it the Christmas Cup. And it's the only thing I actually pull my finger out to organise.
There you go. Well,
so
give Collective a go and let us know what you think. So I said, so the e-commerce is know the origin. So a lot of us are now much more conscious about where our clothes come from, where our beauty products go when we've used them. And I've kind of been doing more shifts towards kind of reducing my plastic or eliminating plastic. So it's founded by a lady called Charlotte, and she studied fashion at the I can't remember the particular university in London that's notorious for fashion, but she then went out to, I think it was Bangladesh, to sort of see the factories, and was just kind of like, there has to be another way of doing this. So it was around the time, if you recall, there was a factory collapse in Bangladesh, and a lot of the kind of mainstream high street brands were asked about it, and they were like, were our clothes made there? And they weren't able to tell, and it was just kind of this complete lack of transparency in the industry. And you know, it's kind of bubbled up to the surface recently again with Boohoo, and just working, not even in the UK, but just working conditions, the amount of pay people who work in this space get, how much goes to landfill. So she wanted to basically do this differently. So she designs all her own ranges that are sustainably sourced in terms of materials, but also produced sustainably. So their factory that she was using once in Pakistan recycles all its water, and that's, you know, it's a huge problem for dyes. And when there was a drought in the region, theirs was the only factory that was able to continue to stay open and thus pay all the workers. So it's not just green for green's sake. It makes economic sense, and all of the other stuff that comes with it. And also has lots of green plastic-free options in their conscious living stuff. So I really, really love what she's doing, and they're launching new products soon, and onboarding new ethical brands as well, that you can get through knowtheorigin.com. So go and have a look. And the third that I was going to mention was was Edtech. So Immersify Education is founded by Chloe Barrett, and it is initially targeting dental students. So they've got like this really cool app which utilizes augmented reality to help students get, you know, more tactile learning in their syllabus. So I was really, really shocked to know that I think you're at school for like at university for 5 years as dentistry student, and the first time you actually get in someone's mouth is like in year 4. I was like, what? So they have this so cool. So you can get it on the App Store for the B2C offering, and they have a chartistry module. So if you ever fancied learning or indeed testing your knowledge about like what tooth is what, and what all of the different faces of your tooth are called. And they also have this really cool one coming up, which is absolutely terrifying. Actually, you just got like this, you just like point your phone at a blank surface, and it projects like this model's head in, and when you move your phone, you have like the little mirror that your dentist has, and you can explore inside this virtual mouth, and then like charts. So you can kind of like pretend to be a dentist, basically, if you want to have fun. But they're going to be selling directly to unis, and then in the sort of medium to long term, doing more kind of that style of learning for other courses. So medicine and veterinary are obviously obvious markets to move into, but it's just really, really cool what they're doing. And again, just a really incredible team to work with.
Quite funny that dentists don't get working with live patients really till year 4, because in medicine they just pretty much throw you into
yeah, here's a cadaver, go for it.
Yeah, just go deal with it. And but sometimes I think they throw them in the hospitals pretty damn early as well. So it's like, I mean, I'm sure they're not necessarily doing anything too complicated at that point, but it's quite interesting to a dentist.
I don't know whether it's comforting or not to tell you, but that book, I think it's Adam Kay, and this is going to hurt. Yeah. And he said, like, they have the see one, do one, teach one. So I'm not sure that's reassuring to you, but
that's in my household. My wife's a GP, so she's
yes,
and she went to see him live a couple of times, I think, as well. So I'm well as an individual. Yeah. Are there any other businesses you want to just give a quick shout out?
Oh yeah, there's loads. So Housemates is another one of our businesses. So they are looking at disrupting an area of the industry where students, often international, are basically subjected to fraud by landlords, where they inhabit a property that is uninhabitable, or indeed they're just not protected and given security of tenancy and all things like that. So they've developed a tool for landlords to list their properties for students to then find and rent, and it's a completely digital journey where you can get an online guarantor within minutes, and it will handle all the documentation digitally, as opposed to going through agencies who will take a huge cut of it. There's definitely a lot of fraud that goes on in that industry, as I mentioned. So Lydia Jones is set up in Manchester, and her team's growing at the moment. So they're doing some really exciting stuff. Who else? There's a Near Life Tech are doing really interesting stuff with VR training as well. So they're based in Bolton. And they're doing a project with the World Health Organization. So they've done stuff before around like crisis response. So they delivered virtual training into Syria, because obviously no one could get into Syria because of the civil war. So they actually delivered some of the training that was like dealing with kind of collapsed buildings and how to rescue people. So it's pretty, heavy hitting stuff. Really, really important.
That does sound pretty.
Yeah, and we've also got Twine, which is a virtual kind of marketplace for freelancers, creative freelancers, to find jobs posted by companies, and to pitch and bid for work. They saw a huge uptick in people registering for their platform as a result of COVID and unfortunately redundancies. But I think this whole kind of working from home stuff has removed maybe some of the anxieties that businesses had with using a remote freelancer, because it used to feel so alien, but now everyone's remote. So they were also seeing a growth in the number of businesses that were willing to use a freelancer to deliver marketing content. Really interesting business as well for the current landscape.
Right. I think they used to be a neighbour of ours in WeWork.
I think, yes, they were. Yeah, Stuart Logan, yeah.
One final question, I guess, to wrap things up today. I guess we've always spoken about investment sort of no-nos. What are the more common mistakes that you see post-investment where companies have finally received that money? Where are the biggest errors that have been made afterwards? Yeah,
so typically at our stage, there's always a transition that happens as a business goes through the learning curve and the maturity shift of just sometimes it's the first time a business has ever had anyone else other than themselves or their own staff around a table. So there can just be a shift needed to kind of get good board communication, or what's the word I'm looking for? Like regimen, you know, understanding discipline. That's the word I'm looking for. Board discipline. So kind of, right, this is information that I need to pull together for the board, the right level of detail, making sure you're using your board effectively. So what decisions you need to bring there, what level of detail is too much. Producing and accounting is such an area that I talk about this a lot with people kind of at a similar level to me in other funds, but just kind of getting the balance right. So a lot of startups will have just done their own accounts because there's not really been anything to account for really anyway, or they've just sort of used a very basic kind of local high street accountant, like no disrespect, but when it's like, right, we need management information, we need monthly management accounts, we need your P&L, we need a balance sheet, cash flow forecast, yeah, where are you up to? And the high street accountants were good for just like going, I've produced the thing that you need to do at the end of the year to put on company's house, but not that like, what's an investor going to want to see? How do we account for SaaS products? How do we recognize income? Do we need to accrue this or not? Like, they just don't quite have that level of input, and they probably just aren't paid by the business even at that point to have that level of input. So I think there is a transition that we're going on with some of our businesses whereby we've kind of come in, and the only thing we really need to know is, as we were talking about earlier, was that burn rate or the runway. Like, when are you going to run out? That's kind of all we need to know. And if there's any significant changes in your burn rate, we need to know, because that's going to bring your runway in a bit closer, too close for comfort. But there comes a point when it's like, right, you're going to be taking on a venture capital funding soon, and they're going to want to see monthly management accounting info. And it'd be better if you start to shift over, if you're going to start generating sales soon, you need to get a good accountant who's there and ready to help you to get into the right shape for VCs, because they're going to want to see historical management accounts as much as you have anyway. So yeah, there's kind of definitely a maturity journey that a lot of businesses go on. And I also think kind of understanding that you need different skills is an easier one, but then thinking about how you can pay for that, because you can't just get someone who's an expert in X, Y, or Z to sit on your board for free, or you might be able to actually. So I think a lot of founders have to have the gift for the gab. So selling your vision to someone and get someone who would probably charge themselves out for 500 plus quid a day, and getting them to give you, you know, advice for free is kind of part of being a startup founder, I suppose. But also recognizing when you need to bring someone on and when you need to argue the case for that further investment with your board. And I think thankfully it's not something that I've come across yet, but I think it's probably a funding round later on down the line. But when you can sort of see that perhaps a co-founder or a senior member of the team is just perhaps not the right person long term, and you can already see that coming, it can be quite difficult, because a founder, you know, often will have quite personal relationships with those people. And, you know, some founders are really good at sort of separating out that emotion from what's needed, probably too good at it. I'm quite suspicious, actually. But yeah, so some sort of struggle with that. And I think, yeah, just being able to be like, you might not have the right person in this role long term, and you might need to get yourself acquainted with the concept that they might not be with the business long term, or just like having your ears and eyes open for talent that you know you're going to want to bring in down the line. So any other post-investment errors? I'd say they're generally related to cash flow and stuff really for me. I think also, I guess, maybe the tendency to just be led by what is going on. So I think, you know, if you release something in the App Store and you're like, oh, this is great and everything's great, but ultimately it's like, okay, but is it though? So, you know, you've said that you've got like X downloads, or you've got X people using it, or you're having X conversations. It's the context that you kind of need to bring into that. So like, how many would you have expected? Like, what is the total addressable market? Is that a portion of it? Do you think you can be doing better? How are you going to do better? How are you performing against last month? What's the reason for that? So it's kind of like board packs that I see quite often will have like analytics or graphs shoved in there, but it's more important. The commentary is more important. And I think quite often that gets left out because it's words at the end of the day, but actually that's the important bit. It's like, this tells us this, and this is where we want to be, or this is where we were. So yeah, I think there's some of the key common areas.
That's great. Look, I think sort of let's wrap it up there. Jess, that's been perfect. That's been great. Really, we do appreciate you joining us today and sharing all that information. I'm sure that people scribbling down notes, and they're probably getting in touch with their pitches, just ongoing list of what you've got going on at the moment. But look, if anyone who's listening wants to get involved with the podcast, has any questions, feel free to connect with me on LinkedIn. I don't want to speak for you, but I probably likewise for Jess to reach out and get in touch with us. Happy to answer questions, or if you want to contribute to the next podcast itself and have a topic or questions that you want to ask, please do just get in touch with us. But yeah, let's wrap it up there. Really appreciate everyone for listening, and yeah, hope you all have a good day. Thanks a lot.
Thank you.